Hey everyone, welcome to This Explainer. Today we're unpacking something pretty shocking. We're going to break down the mechanics of the Red Rock secured precious metals fraud. This was a massive operation that siphoned tens of millions of dollars right out of the pockets of everyday investors. But we aren't just looking at the crime itself. We're going to uncover the harsh, often completely hidden realities of asset recovery when these fraudulent companies finally collapse. If you want to know how to protect your own wealth, you're absolutely in the right place.
Here is what we're looking at today: the anatomy of this gold scam, how regulators dropped the hammer, the complicated emergence of a successor company, the sobering reality for victims, and finally, how you can actually protect your retirement savings. Let's get into it.
Section 1. Anatomy of a gold scam. Let's jump right in and look at exactly how this bait-and-switch operation was built.
So think about it. When you buy physical precious metals, you generally expect to pay a small premium over the market spot price, right? Well, investors working with Red Rock Secured were promised a tiny markup, just 1 to 5%. But behind the scenes, they were secretly charging markups of anywhere from 100 to 130% on specific assets, like the Canadian red-tailed hawk coins. I mean, investors were literally losing more than half of their money the exact second the transaction cleared.
And this wasn't just a one-off mistake. That deceptive pricing model devastated the retirement savings of over 700 individual investors all across the country. We're talking about everyday people who worked decades to build a nest egg, just completely wiped out by an invisible, hidden premium.
Now you might be wondering, how do you actually get 700 people to hand over their life savings? Well, Red Rock Secured aggressively preyed on retirees' fears. They used unlicensed investment advice and straight-up scare tactics. They painted this terrifying picture of traditional financial markets on the brink of total collapse, pushing these clients to liquidate perfectly secure 401ks and roll them over into these wildly overpriced metals.
Section 2. Regulators drop the hammer. Because eventually, a scheme this big is going to attract some serious attention.
Looking at the timeline here, you can see this scheme ran pretty smoothly from 2017 to 2022, just reeling in more and more capital. But the wheels started to come off in May 2023. That's when the SEC, alongside California's DFPI, filed federal lawsuits. Less than a year later, in April 2024, the court entered its final judgment, permanently shutting the operation down.
And man, the financial hammer fell hard. The court handed down a staggering $76.4 million judgment against the company and its top executives. That massive figure included disgorgement, which basically means forcing them to cough up the stolen profits, plus interest and some really heavy civil penalties.
DFPI Commissioner Clothiel Hewlett really hit the nail on the head with this quote. Calling it despicable underscores just how aggressively regulators view this kind of exploitation. It really highlights the personal impact here. This isn't just a white-collar numbers game. It's the depletion of hard-earned life savings just for pure personal greed. If we look at the exact breakdown of those penalties, you'll see the liability wasn't just pinned on a faceless corporate entity. Red Rock Secured LLC took the brunt of it with over $56 million in disgorgement, sure, but the executives were held personally liable too. CEO Sean Kelly, along with managers Anthony Spencer and Jeffrey Ward, were ordered to pay millions out of their own pockets. Section 3. The successor, American Coin Co. Because in cases like this, the story rarely ends in the courtroom. In what looks like a classic attempt to dodge a tarnished reputation, sources indicate Red Rock Secured basically slapped on a fake mustache. They rebranded as American Coin Co. They just changed the name on the door and tried to keep operating in the precious metal space as if that massive federal judgment didn't even exist.
So you're probably asking yourself, wait, if it's basically the same company, why can't the victims just sue the new entity to get their money back? Well, that involves a really complex legal concept called successor liability. In theory, this allows plaintiffs to hold a new company responsible for the old one's debts if it's just a continuation of the same business. But theory and practice? Two very different things. Actually proving successor liability is an absolute uphill battle. Victims have to prove fraudulent intent, they have to untangle crazy corporate webs, sometimes involving offshore accounts, and the legal fees are just exorbitant. It is astronomically expensive to fight these battles, with absolutely zero guarantee that you'll see a single dime at the end. Which transitions us to the most sobering part of this explainer, Section 4, the harsh reality for victims.
Here is the toughest pill to swallow. Despite that massive $76 million judgment existing on paper, the SEC made it clear. There is no distribution fund. The money is just gone. There is no hidden pool of recovered assets waiting to be handed back to those defrauded retirees.
If the funds have already been spent or hidden, that court order is really just an expensive piece of paper.
When a fraudulent company goes under, it enters liquidation. Think of it as a legal fire sale. A trustee steps in to auction off whatever is left, office chairs, servers, remaining inventory, just to pay off debts. But there is a very strict, legally mandated line for who actually gets paid first.
And this chart visualizes the painful truth of that line. Who is at the front? Secured creditors, like major banks with collateral, that eats up the vast majority of the funds. Next up are the lawyers and administrative costs to run the liquidation. Defrauded investors? You're considered unsecured creditors, meaning you are dead last in line. By the time it's your turn, the pie is entirely gone.
Section 5. Protecting your retirement savings. Because recovery is nearly impossible, prevention is your only real defense here.
Listen, if you only take away one piece of information from this entire explainer, let it be this. You must always check the spot price of gold or silver before buying. It's so easy to search online. A normal, acceptable industry premium ranges from 3 to 20%. If a company is trying to charge you 130% over the market price, you are being scammed, period.
If you are thinking about a Gold IRA, you absolutely need a process. Just follow these 4 steps. Step 1. Check the live spot price yourself. Step 2. Demand a complete written price breakdown per ounce. If they won't put it in writing, just hang up. Step 3. Verify their SEC or FINRA credentials. And Step 4. Absolutely walk away from any salesperson using high-pressure urgency tactics. Legitimate investments do not require you to act in a panic.
Always keep your eyes peeled for these red flags too. If someone guarantees high returns, run. If there is a total lack of pricing transparency on their website, huge warning sign. Watch out for those fear-based pitches designed to panic you, and be extremely skeptical of generic, overwhelmingly positive reviews on what are likely just paid affiliate websites.
We have just seen how fast decades of hard work can vanish into thin air, and how powerless the legal system can be to actually get that money back. Ultimately, the responsibility of due diligence falls entirely on you. So take a hard look at your portfolio, look at who you are trusting with your assets, and ask yourself, before you sign over your financial future, who is really guarding your retirement? Thanks for joining me on this explainer, and stay vigilant out there.